Talk about the structure for a second. Real estate investment trust means that a real estate oriented company will put together a variety of different real estate assets in a structure that can be publicly traded. Some of the metrics to qualify as a REIT, that company has to pay out 90% of its earnings, of its taxable earnings to you. So why would a company want to pay out 90%? How's that good? Well, the reason the structure exists is so it doesn't get double taxed. So the company doesn't get taxed on its earnings, and then it pays it out to shareholders, and then you get taxed. You still get taxed, and dividends or cash flow you receive from REITs is still, for the most part, ordinary income to you. So you get taxed on it. But if the company is in fact in the REIT structure, they don't. They get a tax break because of that. Now, why would they still want to pay out 90% of their earnings? It's really their taxable income, is because they, as a publicly traded company, get to access the capital markets. They get to issue stock. They get to borrow more money. So now they can become a larger, scalable company that can own big, expensive real estate assets. But there's a lot of different kinds. So there's apartment REITs, there's housing REITs, there are commercial office REITs, and there are hospital REITs, there are industrial REITs, there are data center REITs. So REITs are a structure, and then depending on the company, they're going to be specializing in all different sectors of the economy. And some of those are good, some of those are bad. For example, healthcare REITs have done really well over the last couple years. Data center oriented REITs have done pretty well. But all sorts of other REIT categories have really struggled. So you've got to be careful about what real estate is owned by the REIT. And I'm just talking about publicly traded REITs. There's private REITs. There are mortgage REITs, which are investing in mortgages that are backing big companies. The way I typically will do this, own a basket of REITs, and there's several indexes that will do that. And that's how I'm comfortable using it for a small portion, because REITs really are a part of multi-asset class income investing, which is a style I really believe in. And the yields are higher. So the S&P 500 right now only yields about 1.2, 1.3% in dividend yield. REITs are going to be in the 4% dividend range. So they pay out a lot more income than the average stock does. And that's another reason to take a look at them.